Traders, what's going on? It's Kyle from K Capital. It is January 10th, about 5:45 Eastern Standard Time. Hopefully everyone's having a great weekend, is excited for the market opening up tomorrow. Right now, I think futures are flat, I'm thinking. Let me take a quick check. I stand corrected. Futures are actually slightly down in the U.S. The Chinese market is getting crushed again, and crude is currently down 40 cents. So looks like we're going to open up pretty weak tomorrow again, but we have some positive shorts here that I want to go over on our watch list. First is RATX. So looking at the long-term trend here, to start, this tested the 200-day moving average several times over the last year, and once it broke through, it's been trying to really break out and break through that level several times. And I think, this most recent breakout is going to follow suit with, the last two. The fact that the overall macro environment is pretty bearish, I think it's just a testament to this is definitely going to trade back down to 2, if not lower. Friday, we had a nice bearish candle here, indicating selling is definitely going to continue. So, granted, fundamentally they may have had a great quarter, last November or last quarter. I think this definitely sells back off. I'm going to wait for the EMA ribbon to kind of flatline a little bit, just like it did here. And then once we see kind of a full, bearish movement down to the 200-day moving average, we'll go short and expect this to test 150, if not lower. EMAN is another, which of the two I like ARTX the most. One thing that caught my eye is the fact that this just could not break through the 200-day moving average several times. Friday we traded down, but the reason that I like ARTX a little bit better is solely because the EMA ribbon's more or less trading up pretty high and pointing up right now, all of these indices. Or all of those indicators. So that really tells me that this might trade sideways and, if anything, test the 20-day exponential moving average before either retesting the 200 and then pulling back, or just trading sideways for a bit. So they're the two options going into the week that I'm looking to more or less trade. Again, to the short side, if we want to get to the overall macro environment, the reason that I'm not really looking for any long is quite simply that we just started the year pretty horribly. January historically has always been a positive month. The funds usually are opening up new positions because their book is now reopened for the year. Or January and December is usually when they reopen. So institutional clients are usually buying into January. So it's more of a psychological uptick in the market. And conversely, FY16 just opened completely down. If we want to really zoom out and take a look at what levels we're testing here, really we're testing the dip in October 14 and then over the summer here. So I would expect a little bit of hopefully buying. But again, the saying is don't try and catch a falling knife. So I'm not going to try and buy into this in any term of swing trade. It just doesn't make any sense. I'm better off really just playing what the market's telling us. And right now it's really saying, everything's pretty shitty. So we're going to definitely be short and just see if we can see any type of, stability come out of this complete drop-off. So I'm going to really just wait and see. And the one thing that kind of indicates a strong reversal is long tails like this. It happened in, October 14, and it happened over the summer. And really all that is people buying up the lows of the day, and that's when you really start to see kind of the market kind of baseline and then reverse up. But right now I don't see that. Maybe we see it Monday and Tuesday, but right now we're not seeing it, and that's kind of just telling me I'm going to stay short. So those two watch list stocks are what I'm looking at. Sticking on the macro side of things, if we want to look at the Russell 2000 or the small cap space, we can see a similar pattern versus the Dow and the SPX. The scary thing, in my opinion, is the fact that here's the long-term trend in the Russell 2000 all the way back to 2010. We're testing the low from October 2014. We already broke through the summer's low, and if we break that level, there's nothing to really support us. You can make the argument in this level of roughly 1,000, or in this level of roughly 950, we might be able to see some technical support. But right now it's definitely, if we open and close below this level, I think we definitely are in for a very interesting bearish first quarter in the small cap space. So that is the two macro indicators I follow, or two macro indices, both really indicating a very bearish sentiment across the board. That said, if we want to go to our current positions, one that has done very well, and I think we're plus 20% return in this so far, is NCTY. Again, the macro trend for the last 2 years has been down. We saw this huge spike over the last month to close the year from roughly 1 to 4, and naturally, that's just a perfect target to short, because nothing fundamentally really warrants a spike like that. And any spike prior has been completely demolished, whether that was here in July or if this was here in September of 14. So the same thing happened here. Huge spike. We wanted to go short. I kind of waited to see what would happen along the EMAs. We broke through that and went short, I think, at 329 to 339. And we're sitting at, I think, again, 20-25% return so far. There's no really solid support holding this up until you get to the 238 to 223 level. So I think we have another 40 cents here before we see this flat line. At least that's what I'm hoping. So nice return so far in this position that kind of, is trending with the overall market. And again, it's just the type of situation to where this is one of our 5 key patterns that we trade, and it's working out very, very well so far for us and our members. On the flip side, we have MDXG to the long side. This is currently holding this long-term support trend both horizontally and diagonally. The one thing that really caught my eye here is the fact that this level has held twice so far since we saw a nice breakout down here all the way back in 2012. And it's just shot up. We saw a nice pullback all the way to this level. And really, what caught my eye is the fact that these two patterns are very similar, and that this diagonal trend line has really served as really solid support twice. And I think we're going to form that same type of position right now. And I think this is going to play out to where it's going to start to trend along this trend line and eventually continue up, break through the 200-day moving average. It really just depends on the overall market, and if we just have a continuation of a massive sell-off, then we'll just have to close and take the short loss, or small loss, I should say. But right now, we're seeing it hold both the horizontal area where we've tested multiple times and then broke through that, and then we continuously held that all the way through January of 15, and then again in August, and then we're seeing a consolidation along it again now. So let's see how this plays out this week. Hopefully we hold this trend line going all the way back, like I said, to the original indication of when this stock will reverse, and I think we're in that pattern now. So far we're going to continue to hold that position and just see how that plays out. Again, NCTY, MDXG, and SD are our two main positions. SDOC is the new ticker for SD. And obviously this is one we've been in for quite a long time, and it's obviously a very long-term play for us because it's really a call option on crude. We added to this Friday at 5 cents, really taking our average price to 34 cents. So right now we're still sitting on a loss, but it's the type of situation where you're seeing a lot of buying in the OTC market. I think they traded 165 million shares. Granted, it's at 5 cents, so on a dollar basis, it's pretty much normalized when we traded on the same, I think, the same exchange before getting delisted. But my main thesis here is two things. One, that they do have cash to at least survive 2016. Their debt is not maturing until 2020. To cover their interest expense, which I think is in the $77 million range, they do have the cash from operations to cover that. So even from a free cash flow standpoint, they're cutting CapEx. So even from a free cash flow standpoint, I think they really can cover the interest expense and the debt liability they have in the short term. If we don't see really a crude bounce by midpoint of FY16, this company probably will already be bankrupt. And obviously we'll take the tax loss and we'll recover some of that through the write-off and taxes. But nonetheless, that would be a really sucky situation. But it came with it, and we knew it from the beginning that this is a long-term play. It wasn't really a technical swing trade setup, and there was definitely risk associated with it. And I alluded to that when we alerted, the new entry Friday. So, definitely risk-reward situation to where our average price now at 34 cents. If we see a spike this week up into the 20s, we'll recover a significant portion of the loss, and we'll probably take a little bit off the table to kind of steady the portfolio, at least for this position, and hopefully sell in the 20s, if not the 30s, to lock in a little bit of the gain and the recovery. That said, I definitely think if we do see more buying coming in, I think that it's a situation where, maybe it's a turnaround story and we start to head back up to, $1 share price and we get relisted, and, everything from there may be all bullish. It really just depends on crude. And really my take on that is, I do expect $50 to $60 crude by the end of the year, FY16. So I think we're going to hold this and hopefully see a nice pop up into the 20 cent, if not 30 cent range, where we'll recover this loss, at least to some degree. But that's really the overall positions. Again, to recap, we have 2 stocks that I'm looking on the short side of things for our watch list going into the week, and we have 3 open positions right now that are swing trades, and 1 long-term trade. So if you have any questions, please shoot an email to Kyle Matthew at K Capital Advisors, and have a great rest of the weekend, and we will talk this week.